Hello everybody and welcome to my second video in my three-part series about my preferred ways to invest and what I think is the way to invest going forward with the current market the way it is. And so that's the reason why we focus on growth stocks in this channel, is the idea that yes, there is very, very high denominator growth, i.e. the dollar is getting devalued so fast. And therefore, growth stocks might be one of the only tools where we can actually outpace the monetary printing that's happening and the growth of the US dollar. So let me just begin with growth stocks, describing the thesis for investing in growth stocks. So let me first ask you a question. Do we invest to make money, or do we invest because we want a volatile savings account? And so I'm going to argue that most people who invest, actually, it's more like a savings account. You're really not making money in real terms. You're making money in nominal terms. But in real terms, you're not making any money because the monetary inflation is so high. So briefly, a bank's savings account, right? Today, now that the rates have been increased more than tenfold, you get about 3% on a savings account, and 2% on checking accounts if you go with a neobank. So nothing, right? Next to nothing when monetary inflation is 15%. And I want to talk about, why I always say this number of 15%. Well, first of all, we need to distinguish. So you have nominal returns, which is how much you think you make in US dollars. I made, 10%. I made, I don't know, $10,000. That's how much you think you've made. And then you have real returns, which is the amount that you've made, the money that you've made, minus monetary inflation. Monetary inflation has to be removed from the growth rate in your investments for you to get the actual wealth creation, for you to get an actual estimate of how much wealth you've created. And monetary inflation is not CPI. Like most people talk about CPI and they talk about inflation meaning CPI. CPI is a construct that really started getting popular about 20 years ago. Before that, monetary inflation was the only thing before CPI started becoming popular. If you go back to the early 60s, 70s, monetary inflation was a main thing, right? That's what Milton Friedman taught us. Monetary inflation matters. The CPI is just a basket of goods that changes all the time. It's going to change again on January 1st. And it's based on a stereotypical buyer, which does not exist because everybody is different. Inflation is a vector and everybody is different. And if your views for your money is to say, buy expensive art or buy a house on Palm Beach or buy a house in the Hamptons, if that's part of your view of where you want to spend your money, then the CPI doesn't apply to you. Your inflation then is not 7%. Your inflation then is like 50% because what you're trying to buy has increased 50%. So that's why we can't use a general stereotypical inflation number based on a basket of goods where you can't find a consumer who buys exactly what's in that basket of goods. You have to look at the total money out there. And you have to look at monetary inflation, i.e. how much the money stock has grown, how much more money there is out there. And so I want to do that in this video and talk a little bit about these monetary problems, and that will help us understand why growth stocks are kind of the only way we have left to beat monetary growth, to beat the denominator. So to earn a real return, you must beat monetary inflation. That is, you must beat the denominator. That's the name of the channel. That's because, it's the reason why I buy growth stocks. I mean, I love technology, sure, but growth stocks are there to mostly help me beat the denominator. And what is the denominator of our life? What is the denominator of everything we value, of everything we hold near and dear? It's the US dollar. Whether we want it or not, the dollar denominates our life. Everything we value, including our time, because most of us go to work and we exchange our time, everything we value is divided by the US dollar as the denominator. The denominator is the US dollar. It's like if you're going to make a distinction, say you're buying 2 flight tickets, one of them takes you 10 hours with 2 connections, and another one is direct, but the direct flight costs more than the indirect flight, and this dollar amount represents how much you value your time. Are you willing to give up more dollars to save time? The US dollar really is the denominator of what we value in life, goods and services, and that denominator is getting altered by the current monetary system. So again, we value our time and we exchange it for dollars at work or whenever we make purchasing decisions. We decide whether we want to buy any good or service based on dollars, based on how many, based on dollar denomination. You decide whether you're going to go to that restaurant or not based on dollar. Everything is quoted on dollar. It's essentially everything divided by dollars. And thus, since it's everything be divided by dollars, in an ideal world, you would want no new dollars. If you had no new dollars, you could comfortably save money during your working life. And then when you're old, when you stop working, that money wouldn't need to grow. That money wouldn't need to grow because you could just save, 20% of your money over, say, a 40-year life of work from 20 to 60, and then that 20% would be just enough to support you in your 70s, 60s, maybe 80s. That would be just enough because the money would retain its value. That's what no new dollars would mean. But we have new dollars, which is why prices everywhere go up like crazy, because there are new dollars that are injected into the economy. And this is the plague that is known as, Keynesian economics. Anyways, this is not a video about Keynesian versus Austrian, but that's Keynesian economics. The whole idea is that you have to increase the money supply so that people part with their money, because otherwise people are not going to part with their money, totally overlooking the fact that people have needs and people are going to spend their money regardless of whether the value of the dollar is going to decrease or not. People spend money for a different topic, different conversation. So the point is, ideally, you would want no more new dollars, but that's not the world we live in. No, that's not. In the world we live in, new dollars are created all the time and always. That is the world we live in. That is why we have inflation. That is why, any healthy person today in 20 years, you'll have a loaf of bread at $20, and we won't understand why a loaf of bread is $20, but that will be the prices because of inflation, because of monetary inflation. How does that work? Well, it's through commercial bank lending. Historically, that's how new money goes into the system. Whenever you have a loan issued, whenever you have credit issued, that money is created and then makes a deposit. And more recently, started especially in 2008, but 2020 was even worse, through base money issued by the Fed, money that goes towards either asset purchases such as treasuries, mortgage-backed securities, or mortgage-backed securities. So the Fed can issue base money and buy treasuries to fund the US government. So these are the main two ways that new dollars are injected into the economy, diluting every single dollar that's out there. Every single dollar that's out there is getting diluted whenever the Fed whenever the Fed buys new treasuries issued by the government, or whenever the Fed buys mortgage-backed securities, or whatever it buys. So right now, in 2022, people think that the Fed is going to do QT and they're going to keep going QT. But the Fed is bluffing. And I don't have time for this video, but the Fed is bluffing. You can't keep doing QT because the deficit of the government needs to be financed. And so someone needs to buy that deficit. And that's going to be the Fed who has to buy that deficit. So QE will have to resume eventually, but right now we're in this phase where the Fed is trying to raise rates real fast to shock the market so that we get a quick recession, so that we get plenty of layoffs and that inflation cools down. But even if the Fed could keep QT going, and I think this is a very important point to emphasize, like even if we are in quantitative tightening and the Fed is not creating base money anymore, and even if the Fed unloads the balance sheet, it would not solve the historic problem of banks creating money. That would not solve that problem. That problem existed long ago, long before the Fed started doing quantitative easing, long before. And let me show you some of the stats. So M2, right? M2 is the best measure we have of how many dollars are within the US financial system. And let me show you just this number. This is from 1959, so still within the gold window for more than a decade within that time frame, until October 2008, so prior to the crisis. Monetary growth, dollar growth, was going at 6.8% compound annual growth rate. So that was the monetary inflation. For a period of nearly 50 years, monetary inflation was essentially 7%. So you were already getting diluted pre-QE, like prior to crazy QE that we have right now. You were getting diluted. Actually, since 08, they've done a little bit better, right? 6.5%, but still huge dilution. It's still like not those two periods still have had huge dilution from the commercial lending. And then look from February 2020 until August 2020. We've been at close to 15% new supply. This is all the growth in the money stock. And you can see that in the late 60s, 50s, late 60s, you had what? You had less than $1 trillion in money stock, in money out there within the US financial system. And today we're at what? We're at 22 trillion. So again, in 60 years, the money supply has done a 22x. And so have your investments done a 22x? Well, if you add US dollar and the US dollar bill, that US dollar bill would have lost 22 times its purchasing power. If you had, say, kept $20 bills under a mattress, that's how much you would have lost purchasing power. So your investments likely caught up a little bit with that. But the question is, did they catch up with these crazy rates of monetary printing? And the answer is likely no. The answer is they likely did not catch up to these levels. Likely not. So let me go on. So the latest growth rate has been 15%. I'm rounding it, 15%. But prior to that, and if we go up until 2019, since 1999, it has historically been just under 7% of money growth. Well, that is huge. That is very, very big. That means you start making money once you outpace the 7%. And so let's take the favorite investment of everyone, it seems, on the internet, at least for the past 2 decades, which is, you should just buy the S&P 500 or the Total World Index Fund, or you should just buy a broad index fund. S&P 500 is the best example of broad index fund we have. Since 1995, since that ETF was launched, until today, 2022, the S&P 500 has averaged 9.3%. So 9.3%, that's what it's averaged, versus 7% of monetary inflation, right? And that's 6.8, 7% during nominal earnings. And so you have a little bit outpaced it. But wait a minute, we have to remove tax, correct? Because this is taxed. So if you remove tax, after tax, and this depends on where you live in your tax bracket, I'm not claiming that it doesn't do that. It depends on your tax bracket and where you live, and you may be having that in a retirement account, and so that changes things. But after tax, that's 7.5% after tax, plus or minus 0.5%. And monetary inflation is 7%. And the point I'm making here is that investing in an index fund is a savings account. It is like a savings account. You're not creating new wealth, you're just saving wealth. And I guess it has worked. It has worked well for retirement, but the fact is you haven't been creating new wealth. You've been taking a lot of risk just to not be debased. Just to not be debased. All right. Congratulations. Congrats. 0.5% real returns by investing in S&P 500. Over 60 years, 0.5% in real returns a year. And by the way, if you make this bet today, if today you say, I'm going to invest in the S&P 500, well, you're making the bet that not only the S&P 500 is going to yield 15% a year, because I believe that is the new inflation rate. I believe that's the new monetary inflation rate going forward. But you also have to wish that taxes don't go up, Because if taxes go up, I mean, what happens here? I mean, capital gains in the US at 15% or 20%, depending on your tax bracket, that's very low compared to the rest of the world. What if taxes go up? What if taxes on capital gains go up? Well, there goes your return. I mean, it would only take a new law that says taxes on capital gains is now 25%, and boom, you've just not outpaced monetary inflation. You've lost money on the S&P 500. You're taking market risk. So the point is, when people say the S&P 500 returned, 9.3% a year over the past 50 years or something, they're talking about nominal returns. And nominal returns don't matter. Only real returns matter. Only real returns matter. Because $10,000 in 1995, that's not the same amount of money as it is in 2022. There's been a huge drop in that value. So anyways, let me move on. Wait. So we haven't been growing the money stock at 6.5%, 6.8% over the past 2 years. It's been growing at 15%. So that's really bad. So the S&P 500 is probably not going to cut it. If it keeps growing at 7.5% after tax, it's probably not going to cut it if we're growing now at 15%. And some say, and that's just for M2, by the way, and some say, well, I'm wrong to use, I'm assuming some will say that, but I'm wrong to use 15% because look, the Fed is fixing M2. Quantitative tightening is here. M2 is down. And so they will zoom on the chart of the Fed and they'll do like a nice zoom and it shows a sharp drop. Except if you remove the zoom on the chart, it's essentially flat. It's not down at all, like not that much. And I say, the Fed's bluffing. No, there's no way. They will have to resume QE in 2023 or 2024 because of a government deficit. And I also say, and this is, I think, even more important, that's why the view of the Fed and whatever the Fed does, whether they do QE or QT, is really irrelevant in the argument in favor of growth stocks because the problem is much bigger than the Fed. So this is what I'll also say. Is there a US dollar system outside the US financial system? Would there be any such thing? Wait a minute. Yes, there is. The Eurodollar system, an opaque system of which we know very little about. You typically have to go dig deep in academic papers to try to calculate and learn about how big it is. There's some experts on YouTube that talk about it, but very, very seldom is the Eurodollar system brought up. But it should be brought up. And this is my research on the Eurodollar system. And again, it's shadowy. It's a very shadowy system. There's a lot of things we don't know because this is all offshore. This is all outside of the US banking system. But the Eurodollar system, per my research, has been growing faster than the US financial system. There's been more dollars created abroad than there have been in the United States. And those dollars that are created abroad inevitably make it back to the US in one way, shape, or form. The dollar is the world reserve currency. Where dollar is created really doesn't matter as much. What matters is the total stock of dollars in the world. And the Eurodollar system is arguably, presumably out of control as well, but it is very, very opaque. And once in a while on Twitter, you'll hear about a catastrophe here and there, but we just don't know. We just don't know the size of the money stock outside of M2. Like the Fed has a good idea about M2, but we don't know how many dollars there are out there in the system. The system is a mess. So this inflation rate at 15%, which is my conservative estimate of what it's going to be, that could be way worse than that. We just don't know. We just don't have a clear assessment of how bad it is and how much new debt is created, how many new dollars circulate. But I think it's conservative to say 15%. And thus that's the goal. The goal is you start making money in your investments after 15% return. That's when you start making money in your investments. So you need at least 15% return to not lose money to monetary inflation, at least. Firms that do not get past the hurdle rate, firms that do not grow revenue 15% per year, they are arguably falling behind because they are not capturing the new share of money supply. You know, if 15% more money floods the system every year, any firm should capture at least 15% to stay afloat. Otherwise, you're going to drown. You're shrinking in real terms. You may be growing nominally, but you're shrinking in real terms. And here's an interesting one. The mean revenue growth rate of the S&P 500 is actually 4%. So yeah, the S&P 500 is not growing fast at all. Nowhere near to keep up with what I believe is the new monetary inflation. Nowhere near to keep up what is M2 recent monetary inflation from the past 2 years. And nowhere nearly enough to keep up with the S&P 500, with the M2 money growth over the past multiple years, as described here from 1959 to 2008, 6.8%. Right, that's how much money supply grows. That has not been enough because you're only growing at 4% your earnings in the S&P 500. And so there's other beneficial things that they do, like buybacks, for example, which increase the return of S&P 500. But you also have issues like firms, zombie companies, etc. There's a bunch of issues with that. So it's a far cry from the 15% money inflation rate that we have in the money stock. And therefore, again, going on, would the triple Q, would the Nasdaq be a better contender for a savings account? Better than the S&P 500? Would it be better? Since we need close to 15% to keep up with monetary inflation, and this is and again the ETFs. If you do the long-term returns, if you calculate it on the ETFs, it's not flattering at all for the Nasdaq because those ETFs were mostly started at the height of the tech and telecom bubble, and so you actually, if you do like a 22 or 23-year triple Q calculation on the compound annual growth rate, you get the same as the S&P 500, but that is because of the tech bubble. But if you go much longer term, like since the inception of the index, actually you get a mean annual return of 18.9%, keeping in mind that this will go down because 2022 is not included in this calculation, and 2022 the Nasdaq is way down. So let's call it 18% or 17.5% is what you've been getting from the Nasdaq. And so if you remove tax, I would argue that the Nasdaq is a good contender to be the new savings account. The Nasdaq should act fairly well as a savings account. And it's important because, many of us work somewhere where we have a retirement account. And if you have a retirement account, and you want to get a match, I think picking a Nasdaq product is perhaps the best way to get something as close as you can to a savings account. But again, I don't think you're going to beat monetary inflation with a Nasdaq. I think you're just going to get to it. You're just going to have roughly monetary inflation, which is much better than the S&P 500. But none of this is investment advice. Of course, none of this is investment advice. So again, 15 to 16% after cash. Nasdaq is the new S&P. And if you stay invested in the S&P, you're getting 7% after tax. That's entirely insufficient compared to the monetary inflation of 15%. Entirely insufficient. And so, in conclusion, why do I invest in growth stocks? And why do I pick growth stocks and spend so much of my time? I mean, it's a passion, really. But why do I spend so much of my time? And I think I'm not the only one. Many of us are like me, just looking at tech stocks. Well, it's because it's the only way that you can create real returns this day. And so that's the reason for this channel. Much of the topic of the channel is about finding these growth stocks that are going to do more than 15% a year. And it would be nice to get 15% a year in real returns and not 15% a year in nominal returns. That's why in the channel, I specifically focus on stocks that can do 30%. If you can do 30%, you're getting 15% a year in real returns. That's very good. 15% a year compounded of real returns over 5 years, that's a 2x. That's a nice return over 5 years. And these companies have characteristics that are often visible. They often have declining cost curves, technological adoption S curves. There's hallmarks to these companies, and there's a method to the madness. And these are examples of some of the companies that people have successfully identified over the years, and this is not far-fetched to think you can successfully identify them. Tesla and keep in mind, by the way, all of these returns I calculated as of December 5. Therefore, this means that most of these stocks have been either cut in half, or in the case of Netflix, cut almost 70%. So keep in mind that these returns are much, for Netflix, for example, historically it means it's a higher than 40% historically for Netflix. But Tesla, you can see, despite the crash of 50% in the stock price, you're still at 53% average annual return. Apple, for the longest time, right? Apple, since 2002, Apple, 33% since 2002, Apple. That's really, really good. And Apple actually didn't drop that much for now. Amazon, Amazon, same, amazing return, 31% for Amazon. Again, since 1997. So these are stocks that have found a method to that madness, right? There is a consistent method behind these stocks as to why they actually beat monetary inflation. And Netflix, really, they've been so punished recently, but recently when you looked at any calculation around here, you were at more than 40% average annual return, and that's here as well over 2 decades. So these stocks exist, and I argue there are more and more of these stocks out there in the market. I also argue that the problem is that a lot of these stocks are not in the indices. They're not in the benchmark. I mean, look at the size of, I don't know, a company like Snowflake, for example, which is not in the benchmark. It's not in the S&P 500 at all. Like, you have companies that are like 12 billion with almost no growth, that are quasi-zombie companies that are in the S&P 500, and then you have a company like Snowflake that's not included. Like, it's like you're missing out on a lot of growth stocks when you're in the S&P 500. You're missing out on way fewer growth stocks when you're in the Nasdaq. But the problem is that the Nasdaq is heavily concentrated on Apple, Amazon, Google, the usual suspects, and so you're still getting a return that's closer to big tech than it is to a quicker, faster growing tech. And so that is the topic of the channel. That is why in this channel we look at 30% plus stocks. So thank you so much for watching. Not investment advice. None of this has been investment advice. This is just entertainment. I appreciate if you can like and subscribe to my channel and like the video, and follow me on Twitter at Beat The Denominator. I appreciate that as well. Thank you so much, and have a great day. Thank you.